This is an event that we do every 6 to 8 weeks, and it's really topical, timely. We're trying to get relevant information out. If it's related to one of our strategies or a change we're seeing, then we will make those changes, or we'll get that information out to you by way of the solution series. Sometimes it's more market related or geopolitical, sort of news related. The topic for this solution series is energy, specifically the energy revolution or evolution, however you want to look at it. And there's just a lot of talk about energy right now for obvious reasons, much having to do with the decline in oil and gas prices in the last couple years. But I think the opportunity here, or the relevance to any of our clients or interested parties, is in relation to our new power strategy, which really focuses on the more progressive side of the energy complex. And I do think this is an interesting opportunity to get involved with that strategy. It bottomed on a performance basis back in 2012 and has made some pretty good numbers. We're in sort of a pause, which I'll show you later. But I think in the context of this presentation, we'll be looking at 10 reasons why renewables and progressive energy are still charging despite the low oil prices, and 10 reasons why I think the timing is right for this particular strategy. Anyway, thank you for jumping on, and we'll get started here. So I thought I would start with this interesting quote by the Sheikh Zaki Yamani, who's a Saudi Arabian oil minister 30 some odd years ago. The Stone Age did not end for lack of stone, and the oil age will end long before the world runs out of oil. Pretty predictive work on his part 30 years ago, when all the talk was about how we're going to run out of oil and Hubbard curve and everything else. Strangely, interestingly, ironically, the oil and gas, and I would include coal in that, any fossil fuel-based energy, is really falling on its own decline based on massive supply, increasing costs, and falling demand all at once. So we're going to look at that and why, try to really make a case for severing the connection, the perceptive connection between oil and gas prices and renewable energy. So here's where the first reason, a lot of people sort of make that connection. They say, oh, well, geez, oil prices are down, gas prices are down, so solar should be less attractive. Solar is a technology. It's not a fuel. Oil and gasoline are in cars. Solar is for electricity. And we all say, duh, of course that's the case. But you would be surprised that 9 out of 10 people say, well, gee, solar and oil and gas are all connected. Well, they're not. Solar is electricity. Solar competes with coal, nat gas, hydro, and nuclear. At present, it represents only 1% of our total electricity market. The International Energy Agency just this month suggested that it could be the world's largest single power source by 2050. So we're talking about 35 years from now, solar will go from 1% to a dominant role, more than 50. If you're looking for a growth rate, think about that. Number two is that electricity prices are still going up. So again, this makes a case for why solar is sort of marching to its own beat, irrespective of what happens with oil and gas. Electricity prices have gone up about 20% since 2006. Many coal-fired and natural gas-fired power plants, those production facilities, have seen lower costs, which you can see in the gray bars here. And regardless, electricity prices have gone up. It has everything to do with infrastructure, consumer charges, delivery charges, and even rate increases, roughly 2.5% to 3% a year. So again, this is a driver behind demand for renewables. Speaking of, grid parity is a big deal. Grid parity means at what cost does solar compete with the grid? In 2016, there will be 36 states in which solar is a more attractive option on a kilowatt-hour basis than the prices offered to the same residents of these states. So the way this chart works, on the right-hand side, you see these positive blue bars. If you take the example of Hawaii on the far right, an individual who lives in Hawaii is paying an enormous amount of money for electricity. It's very, very expensive there. And a solar option there saves that individual 10 cents per kilowatt hour of electricity used relative to the natural rates. On the left-hand side is the opposite. So in a state like Alaska or Washington State, where cost of electricity, the actual price paid or price charged, is very cheap, solar is less attractive there. Strangely, solar in Washington and Oregon, not yet Alaska, have some of the largest adoption rates, even though the price of electricity is very cheap. Regardless, in more than half of the states out there, grid parity is with us right now for solar. Wind had reached grid parity several years ago. So the point is that the alternatives out there are priced at a level now that makes them as attractive or more attractive than traditional fossil fuels. It doesn't matter what happens to oil and gas. What's happening in the solar price world? Again, I'm really highlighting solar here. This is number 3. It's really about Moore's Law, which came from Gordon Moore of Intel, and he famously said that the productive side of chips, this had to do with computer hardware, would double every 18 months. Well, that same thing is happening in solar. Remember, solar is a technology, not a fuel. But again, solar prices have been falling dramatically per watt since about 2007, from $8 a watt all the way down to $2.50 and $3 a watt, maybe $4 installed. So you're talking about half of the price in the last 6 or 7 years. This is likely to continue. We're not going to see solar panels get less efficient. They are getting more efficient, and right now they're only about 18 or 20% efficient. They have in the works right here in Colorado at the National Renewable Energy Lab, they have solar panels that are cranking out 40% efficiency. They're not going to be higher priced. They're going to be lower priced. So make no mistake that this whole area is getting more and more attractive. Number 4, I heard this. I heard this physically about a week ago. Someone was just chatting and saying, well, geez, electric vehicles are going to get hammered now that oil and gas prices are down, gasoline prices. So what you have to understand with electric vehicles is that they're not, the buyers of electric vehicles don't make their purchases solely on one variable. I know. I own an electric vehicle. I make decisions on a lot of variables. I know the cost of operating an electric vehicle versus my other vehicle, which is gasoline. Gas prices peaked in February of 2013. That was 2 years ago. Not last year, not last month, not 6 months ago. They peaked 2 years ago and are down 45%. Plug-in electric vehicles in January just made an all-time high as a percent of all vehicle purchases this year, January of 2015. So put those two things together and just believe what you're seeing, not what you're hearing. Gas prices have very little to do with purchases of electric vehicles. Cost equivalent to run an electric vehicle, they say, is 98 cents a gallon. From practical use in my house with my electric vehicle, and this is a C-Max, it's a Ford C-Max Energy, I would say it's closer to 89 cents a gallon. That's about the electric cost equivalent. Powering that vehicle costs me, I'm going to say $12 a month extra in electricity. I would be surprised if anyone spends $12 or less on gasoline a month. It doesn't matter how fuel efficient your vehicle is. So EV buyers are making choices based on economics, social, emotional, and moral levels. Then there's that guy who wants to buy the Tesla or the girl, and they're paying $100,000. They want a Tesla. They don't care about fuel efficiency, frankly. So remember, there's a lot more going on here than just the price of gas. Number 5, no one wants boom and bust cycles, no one being legislature, leadership, government. Remember that oil and gas are commodities. They have very high price volatility associated with extraction of these natural resources. It takes a long time, a lot of lead time and money to get things in place. Countries, states, and counties that are dependent on natural fossil fuels are already struggling. So we're looking at like 10 states here in the United States listed there. We have exporters like Brazil, Mexico, Venezuela. Per capita losses in different states, you see those below. North Dakota, Wyoming, and Alaska are all starting to hurt just as of late. So these boom and bust cycles are raising the eyebrows of leadership, and they're saying, why are we doing this? Why did we become so dependent on oil and gas? And they're really looking to become more resilient and more self-sufficient, less dependent on these traditional sectors. Number 6, there really is an opportunity here for energy policy with low oil and gas prices where they are, and these policies are being put in place. Remember that $550 billion was spent on traditional energy companies' subsidies just last year. This is a real cost. There is misinformation out there about different levels of subsidies. Traditional oil and gas subsidies are 4 to 1 to renewables. 4 to 1, so 4 times as much is spent subsidizing traditional oil and gas as it is compared to renewable. There is a co-sponsored bill, Republicans and Democrats, in Congress now to raise the gas tax by 12 cents. It's currently 18 at the federal level. And there is also a bill out there called the Gas Tax Replacement Act in works now that may actually replace what they call gas taxes with something that's called a carbon tax. And what that does is it really paves the way for that tax to become much larger than 30 cents or 32 cents, whatever it ends up being. A carbon tax sort of has a big impact element to it. And it paves the way for 50, 60, $1 taxes per gallon. Anyway, that's a possibility, and I think the timing is actually right, and it's well supported, believe it or not. Number 7, this is a little elusive to me, but fuel cells and CHP technology, which stands for combined heat and power, are 2 technologies used in centralized power, like utility grids. And they're used on the demand response side. They're used for grid capacity utilization. They're called distributed generation, and they run on natural gas. So when natural gas is cheaper, it makes these alternative options for utilities more attractive. In other words, they don't have to build a new power plant. They can handle their capacity issues and their demand side issues with fuel cell and CHP technology when natural gas prices are this low. So it sort of accelerates the shift to distributed generation. Again, this is a catalyst that's been brought about not by high energy prices, but by low natural gas prices and low oil prices. Interesting knowledge there. I didn't know about that till recently. Number 8, there is a very serious sea change of opinion regarding climate change that is really taking root. And most interestingly, it's coming from the Republican side, with now 51% of Republicans, total of 74% of Americans saying that government should take a strong action on climate change. Climate change is like religion. You either believe it or you don't. It's debatable. I don't even really want to go here, frankly, but the opinion matters in the mass psychology. And when people vote according to their opinions, you will end up with people in Congress, people in our leadership that are on board with climate change. 67% say they will not vote for a climate denier candidate in the future. It's a pretty big deal. Speaking of, Apple the number 9 is that investment in clean energy is rising, and I mean investment from big brand name corporations. And Apple just made a huge announcement. I'll send out this presentation. This is a live link to the video. But Apple just made a big announcement that they're investing $850 million in a 3,000-acre solar farm in partnership with First Solar. It's the biggest corporate buy in history, and it dwarfs everything that we're seeing from Walmart and Google and everything else. They're going to power all of their data centers, all of their retail centers by way of this giant solar array being built in Monterey. So we have corporations that are doing this for economic reasons, for social reasons, for moral reasons. Tim Cook came out in public at the Goldman Sachs investment conference, internet conference, and a heckler in the crowd asked him, he said, "Hey, Tim, what's your return on investment for this solar array?" And he said, "If all you care about is the profit associated with this solar array, do us all a favor and sell your Apple shares." He made a big, bold public statement that said, we're doing the right thing here. We're doing it for economic reasons. We're doing it with a very long-term time frame, but we're doing it, and we're spending $850 million on it. So that's a big commitment. Others have done the same: Google, Microsoft, Amazon, IKEA, Walmart. There's a huge commitment that has happened from our leadership in the last 2 to 3 years, really. No doubt many are trying to get ahead of the tax issue, the tax incentives that expire in 2016. But I won't be surprised if the price of solar and wind comes down, continues to drop to the point where those incentives don't matter anymore. Again, regardless, we're talking about 24 months from now, really. So that's number 9. Number 10, energy investments in clean energy stocks are still cheap. Sorry, cheap got rubbed out there. What I'm just going to show you just in colors, I'm sure this is a little difficult to read. The blue line here is the S&P 500. This is about a 6-year chart going back to 2008. The red line is the solar, all solar stocks. It's an ETF. The green line is global alternative energy. The yellow line is the wind sector, all wind companies. And the magenta line there is the domestic clean energy index, actually our benchmark. What you see here is a giant gap. You see a gap between what the broad U.S. stock market has done and is high if you just sort of look at it empirically, and what has happened in the last 6 years in the renewable side of things. It's very, very cheap on a relative basis. Right in the middle of the chart, right about here, you can see in late 2012, the whole sector bottomed and really started into a new uptrend. The uptrend has not got going yet, but it has gone through this long basing cycle, which from a technical standpoint is super attractive. If all things continue, we should see a pretty healthy move from these levels in the renewable energy and progressive energy stocks. And just if you want to compare it, I've gone to great lengths to actually separate these two, saying that oil and gas and renewables are actually not related to each other as much as you think. But if you must, and you want to compare the two, looking at all energy investments, traditional and renewables and progressive energy, these are the numbers. So year-to-date returns for oil and natural gas, they're down 2% and 3%. Since the bottom in 2012, the end of 2012, oil and gas are down 40% and 24% respectively. You can see what wind and solar and the clean energy aggregates, as well as our own new power fund, have done over those same time periods. I don't think this is just a sort of short-term trend. I think this is a macro secular shift. This is a structural change in an industry that's being recognized now in the stock side of things, but hasn't really been recognized in the mass media. It is happening. It's very substantial. And I think this is just the beginning. I don't think it's anywhere close to the end of this cycle. I think this is a super cycle. So, every day I have conversations with people about their legacy holdings in Exxon and Chevron and Conoco. No doubt some of these companies will actually get into the business of renewables. But for now, if you want to stay in the energy sector and keep your hand in that sector, it certainly would make sense to consider a partial alternative within your holdings. So that would be a shift from something like an Exxon to a First Solar or a SunPower, or just pick off an exchange traded fund that's focused on these renewables. This is what we do in our new power model. 50% of our new power strategy, which is in its 10th year of existence, is allocated to pure clean energy and emerging technology stocks. The other half at present is other game changers, we call them. Game changers are companies that are challenging incumbent companies. An example would be like a Netflix taking over Blockbuster. So this is really an emerging technologies strategy with a heavy focus on renewables, clean energy, clean water, clean technology, clean air. So it's all the good stuff. They're really pure plays. I'm excited about it. It's a passion. It's a very small strategy for us, and it's got a lot of volatility. We've had big years, we've had big up years and big down years in it, but the trend is now pretty healthy, and I think it has an upward bias to it. So that's it. I hopefully made a case for that. Special thanks to the Bloomberg New Energy Finance. They ran an article that sort of highlighted at least 7 of these 10 issues, and I just added some of my own information to it. The Economist ran the article called Season of the Day regarding policy. Clean Edge and Clint Wilder came up with some of the recent data regarding utilities. And then the public poll information on climate change came from the New York Times. This is all recent stuff as of last month. So that is all I had. I appreciate you all chiming in, spending the time with our solution series. If you have other topics that you'd like me to discuss or you want me to go over, looking forward, please shoot us an email and ask those in questions. I can probably put something together that's of interest. That's it. Thanks again, and we'll talk to you next time.